Today's episode of Market Talk is brought to you in part by GrowMark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And a good afternoon. Welcome into Market Talk for this Wednesday, September 29th. Great to have you here with us. As always, I'm your host, Jesse Allen. Thanks for joining us, making us part of your day. MarketTalkAg.com, our home on the web. That's where you can find us, MarketTalkAg.com, and you can find all of our streaming sources there. The latest we have with news, market information, social media, everything. One-stop shop, MarketTalkAg.com. Well, we came back in here today in the grains after a risk-off day Tuesday. We got back most of our losses. We are looking ahead to Thursday's USDA quarterly grain stocks and small grain summary reports, and we're going to talk about all of that and more. Let's bring in Mike Zuzolo with Global Commodity Analytics with us here this afternoon. And Mike, I always get that feeling about 24 hours out from a USDA report anymore. Just that feeling of anticipation, excitement, nervousness, you name it. And, today's markets at least gave us a little bit of maybe optimism or maybe not, I guess, depending on how you look at it. But at least it was a decent day today in the grains ahead of those reports tomorrow.
Yeah, and I think that's a perfect way to frame it out as far as a pre-report mindset, especially given the fact that we've been hitting now in the dollar trade a real bid, and it's really become a safe haven. And Wednesday's price action really showed that, with it just continuing to gain more and more and more steam to the point where it's within earshot of getting up to the highest levels not seen in a year. So we're essentially getting back towards a major moving average. The 100 week moving average is within sight now, and it's the resistance level, Jesse. And that takes us back to the September of last year highs, or the August, September of last year highs at this point. So to have green on the screen, me on the air, and the dollar near a new high for the year, I think that's a good way to look at it from a standpoint of somebody was nervous. And hard red wheat, soft red wheat on Wednesday were number one and number three on the price gainers heat map that I keep track of. I think that did have, especially given the fact the dollar was running so hard to the upside, it did have some smell or some look to some shorts covering, getting out of the way of the small grains report, maybe the wheat being the best of the three major commodities as far as the big numbers that come out on Thursday. And obviously, wheat doesn't have the pressure of harvest to go through after the report comes out. And so we're going into the end of the month as well tomorrow. And I think all these things wrapped up really gave wheat a nice look to it. I would love to see that continue because, as we've talked about many times on this show, we're at a stage right now, especially with the dollar going up and having such a run in the crude oil market. And that's another big feature of, I think, this recent trade is I think commodity indexes are buying just because crude oil and energies, especially natural gas and London crude oil and even unleaded gasoline, have been running so hard and so strong. Obviously, natural gas took a breather today, but I think this is where it goes. The commodity indexes come in and buy in bulk. They buy a certain percentage of every commodity that's in their index. And I think that's really underpinned this market heading into the grain stocks report.
One thing I wanted to pick your brain on a little bit here today, the only market that really saw a little bit of pressure was spring wheat. And I know there's a lot of folks thinking that we're going to see a pretty bullish spring wheat report tomorrow, wondering if maybe there was a little just profit taking, maybe some position squaring in that market today.
Yeah, I think the market has been long spring wheat and short hard red wheat, and I think it's also been long hard red wheat against the soft red wheat because those prices are almost identical still. So I do think that there was some spread unwinding today, and the key will be for me after the report numbers come out is to see a repeat of Wednesday's trade on Thursday as we close out the month and head towards the fourth quarter of the calendar year. And I mean, this is where the momentum traders, the short-term funds, the hedge funds, the managed funds, they've cleared their long positions out very nicely. And you notice that they were short, net short wheat in the soft red complex as of last Friday's numbers. And so, again, I think the wheat really is the key and the dominant feature in my analysis. I'll frame it to you this way, and we've got a couple charts to talk about this in more detail. But my sense, because we're running so hard on harvest ahead of last year, especially in corn, we're really ahead of last year and the 5-year average. Beans were still a little, I think, a couple points behind last year, but ahead of the 5-year average. But we're running hard enough ahead on harvest right now compared to last year in corn, especially, and the 5-year average in soybeans, that we could see some new crop beans and corn sneak into the grain stocks report by USDA. The other thing that we've talked about, I still is a very major concern, is the issue of Hurricane Ida and that inflating the soybean and corn supplies, and maybe even the wheat supplies to a lesser degree, because of the fact that that hit right around September 1st. So when I look at the trade estimates, in terms of the newswire estimates by, say, somebody like Reuters, we're looking at 174 million bushels of soybean stocks tomorrow as of September 1. That's compared to 525 last year on September 1. That's a big drop. That's 350 million bushels less. So if Hurricane Ida or the harvest comes in and takes us over 200 million bushels, that takes you to the very top of the trading range. This is the kind of thing I'm looking for. And I'm a little bit worried about that, because I think we've got a window here where if the USDA doesn't feed the bull and give us these bullish numbers that we're expecting with the type of price action we've seen this past week or two, we don't have any supply yield data coming until the October report. And the seasonals get pretty negative, especially if you keep track of the D's corn and the Nov beans compared to 2008.
Well, we'll pull up those seasonals in just a second. I found this interesting. The past 6 to 7 years, September quarter bean stocks have fallen below trade expectations. But I'm wondering, will we see that trend broken this time around? I think that's a question. I think you kind of posed it there a little bit. Whether or not we get towards the top end of that estimated trading range, we might see that trend broken here, and that I found that a very interesting little side note to us going into the report tomorrow.
Yeah, that's a really good statistic. And, obviously every year is different. The compliance people want to make sure the listener and the viewer out there understand that. And it's true, every year is different, but the funds do program those things into their trading systems. At least some of them do. And so I think it's very important that we have a bullish report to feed, to feed the bull instead of feeding the bear, because of the seasonality that we're in right now.
Let's talk seasonality. And of course, this is a time of year where we normally have a lot of harvest pressure. And I feel like we've been holding up fairly well in these markets despite this rapid harvest pace. I'll pull up the December corn seasonal chart here. I'll let you kind of walk us through this, but give us some of your thoughts on the corn market here as we head into the end of the month and head into this report.
Yeah, I mean, this is where the December corn and the November beans early on, before we got to June, had a really strong price reflection, and similarities to 2008 and 2012. The fundamentals you and I have talked about, it seemed more like a 2008 market led by the soybean oil, led by China demand. And so I still am hanging with the 2008 model year as we go into harvest. And this is where it goes back to talking to clients and saying, look, in December 2008, we had a corn price that was right around the same price as we're at right now, 535. And then after that September report, we just pretty much went straight down into the middle part of November, and we took a lot of premium off this price. So it is worth it, in my opinion, given Hurricane Ida and given the fact that the dollar is up at 1-year highs, and it's probably going to start impacting our exports negatively. And I think most importantly, when it comes to the soybeans too, we are getting planted in South America. Brazil is getting rains. My colleague in South America, he and I talked yesterday, and that is exactly what's happening in some of the drier areas. There's more that's needed. There's northern Brazil that needs some more rains. But the farmers are running now, and they are holding on to some pretty substantial supplies from last year. So my mindset is, all things being equal, especially with the dollar doing what it's doing, let's assume, for the sake of risk management purposes and hedging, that we do have a 2008 similar pathway in terms of the price action after the report, especially if USDA doesn't give us the lower end of the trade guess. So what's that mean? Well, corn, the average trade guess is 1.15 billion bushels tomorrow. The lowest number is just below a billion bushels. I would love to see USDA come in and take us down to a billion bushels, because then we can start talking about yield again and start talking about how fast harvest is and how dry the corn is. And all of a sudden, we maybe can go sharply higher in the corn market instead of sharply lower like we did back in '08.
Same question. We'll flip it over to the soybean market heading into this report. I'll pull up the November soy seasonal chart here, and to me, it looks a little bit comparable to that corn chart we just had,
Yeah,
Mike.
and the neat thing about this soybean chart is you noticed in the corn chart, we didn't get nearly as high in the middle part of the year, the growing season, in that June, July, early August time period in the corn in 2008, in this year's corn, as we did in 2008. But notice how soybeans, they actually got up there pretty high. I mean, they were able to get up there to the levels not seen since March of 2008, and they did it a couple times. And so that almost looks like a double top, unless you can change the dynamic of this market. But notice again a very big break after the grain stocks report in 2008 for November beans. These are the types of things that I think it's worth buying 15 cents of puts. In terms of 15 cents a bushel plus cost on some November bean puts, or put straddles, buy a put, sell a put, or corn puts, because I think that's where your risk reward could be 3-to-1 with the type of break that you're looking at potentially if we get this type of price action on after the Thursday report this year, as we did after the September grain stocks report back in 2008.
Well, and you mentioned puts and the potential there, and we think about the low volatility in puts right now, and you kind of alluded to it, but I think that's a big thing that we've talked about this quite a few times, but it's a big thing for growers to consider right now. Just the fact that a lot of that volatility is out, and you mentioned, I mean, puts are fairly cheap right now, Mike.
Yeah, they are, in respect to especially where they were last year at this time, and earlier this year. I think the other thing too, Jesse, goes back to what we've talked about as well. That the cash basis has just been torn to pieces in some areas, especially along the river system, because of Hurricane Ida coming right when we were getting ready to start full tilt on harvest. And I think this is where the trade is really going to watch that cash basis, watch the end users after the grain stocks report, because it's either going to be they don't have enough bought or they've got too much bought. That's really what it's boiling down to me, based upon what USDA says about the grain stocks report. Yields in corn right now, I just talked to some clients today in middle part of Illinois. They're getting about 220 on dry land corn. They're getting, irrigated corn's actually worse, running 180. This tar spot has turned the corn crop in Illinois upside down at this stage, where the irrigated stuff, even if it's had a fungicide applied to it, doesn't seem to be performing at all well. Another fellow I talked to, Northern Illinois, right in kind of the heart, not far from DeKalb, Illinois, kind of the place to farm if you're not in Iowa, is right there in that part of Illinois. He's running, right around that same area, where it's hard for him to get above 225 in corn right now. And I think these are the types of yield numbers that make me think that the end user may be short bought. They may need corn depending on what USDA says tomorrow. So that's where it goes back to, if I have to spend 15 cents on a put and get a bullish report, I think a 45-cent rally in corn is a fair number. And all of a sudden that gets you back to $6 in March corn, 200 bushel to the acre times $6, $1,200 gross revenue per acre. Now we can talk business again.
I'd love to get your thoughts on the outside markets. Obviously, a lot of nervousness there. I want to circle back to this a little bit. You mentioned the dollar, trading at highs of last year. We see crude oil trading higher. The VIX, that was up again today. We have a looming potential government shutdown on Friday. If that happens, the debt ceiling, all this stuff going on in Washington, D.C. right now, and the nervousness that's in the stock market because of that. What are your thoughts on what we're seeing in these outside markets right now, and how much is this going to play into what we could see with the reports on Thursday?
Yeah, that's a really good point. And this is why I think we need to get a bullish report from USDA, because those tailwinds in the macro markets of what you described have become strong headwinds. And you throw on top of that China cutting power because they either can't get enough coal because they're still fighting it out trade wise with Australia, or they have gotten too little of supplies of other types of energy to substitute for coal in their main manufacturing, what we would call the Rust Belt of northeastern China. These are issues that will come back and turn around and lower our demand, along with, that's my fear, especially with the sharply higher dollar, especially with the supply chain issue and these higher shipping rates. And we still are sitting at 13-year highs on the Baltic Dry Freight Index. And so this is where the outside markets, except the energy rally that we talked about a little bit ago, and the way the commodity indexes are probably rebalancing into some strong commodity mindset buying here. This is where these tailwinds on the macro side, which we've talked about for a couple, 3 months, are starting to become major headwinds. The thing that I saw on Wednesday that is really worth noting and watching, to answer your question more specifically, is we had that dollar index rallying like we talked about, but that did not bring new lows in the Brazilian real. It did not bring new lows in the Chinese yuan. These are the two currencies, I think, especially, that have to be watched in terms of the agriculture complex, whether we're talking hogs and cattle or whether we're talking soybeans. And I think that Brazilian real in particular, and the Chinese yuan in particular, is in part why that pork and bean trade, that relationship that's been so strong between the price of beans and the trend in the price of hogs, has been so good this year. So this has been a major part of my analysis, and that's what's going to be in the fourth quarter. Is if Brazil's planting, they're getting rains, and the Argentine and Brazilian farmers both have an ample amount of soybeans to sell that they haven't put on the open market yet, and all of a sudden their currency starts to weaken and their buying power goes up in terms of how much better that is for them to sell to other countries. It's going to be really tough, and I think that's what we got to have to plan for.
I want to make sure we have time to comment on livestock, but another thing as well that I'm starting to see a lot more chatter about on Twitter, the rise in natural gas prices, fertilizer, urea. I know potash was 10% higher than last month, was the number I saw today. Urea is 5% higher than last month. So some of those inputs, that's starting to worry farmers out there as well as they're planning for 2022, Mike.
Yeah, and this is where the wheat and the corn can come back in and support each other. And this is where, the Russians just announced that their export price for wheat is going to jump up from $50.90 a ton up to $53.50 a ton at starting today, essentially. And that's really key, because that in part is due to what's going on in the fertilizer market. I had a lot of clients call me when they noted and heard that the Chinese were going to shut down their phosphate and export market for some of their fertilizers and keep it in house. And we can expect more of that in other key competitive nations or competing countries for agriculture, Jesse. What this really leads to is the idea, and I think the new crop bean corn ratio is already starting to price this in, because it's already heading down towards 2.4, 2.44 is where it's at right now. But it's already starting to see the soybeans for 22 November go down compared to D's 22 corn. And this is where that grain stocks report is very meaningful, in addition to some of these issues on the input side. So soybeans, as I look at them, and I've been more negative soybeans than I have been corn this year, and I was last year as well. As I look at it as much as I possibly can without a tainted eye, and trying to fit the analysis into the discussion. And that's hard to do as an analyst. But when I look at all the major points, I really do think soybeans need to be looked at harder to sell in 21 and 22 based upon what USDA gives us here at the end of the month.
Cattle and hogs, I want to make sure we touch on them here quick as well. Fairly quiet day today, looking like we might have run out of steam in that hog market off that hogs and pigs report. Cattle on feed, fairly quiet today. We saw some activity in feedlot country, looked pretty steady with last week. Any thoughts for our livestock producers here today?
Yeah, I could see a pause in the hogs and then another leg up if we continue to see strong beef and pork exports here in the fourth quarter, because that hogs and pigs report, I don't know about other analysts, but that really blew me away. Not just the real-time numbers of what we have right now, but the farrowing intentions and what we have to look forward to as far as well less than 100% of last year. We're just not going to catch up in terms of getting production up. And we've got these other countries with ASF and some with foot and mouth. We've got some issues in the pork production for the world. And I think that continues to support the beef, like we've talked about. As far as cattle go, I really like the idea that maybe the cattle market is now at a fair value level. It seemed like the central stockyards sales in auction today at 122, 123, 124 was supportive enough to justify the October fats don't need to go lower at this stage. So I'd pull off hedges at this point in fat cattle, maybe keep them on for another couple days, depending on what the corn does after that grain stocks report. But feeders too, another couple dollars lower, $3 lower. Probably not worth having hedges on after that. I've told clients today that I talked to and wrote out in the email this afternoon, I really do feel like that between now and November, that Dees fat cattle contract could have about a $5 rally. So that's what I'd be looking for between now and the holidays.
We covered a lot today, a lot of great insight. It's going to be a busy day tomorrow at the end of the month and those USDA reports. And I know if producers need to reach out and get a little advice from you, Mike, you got a lot of great expertise and analysis, and they can find you very easily online, can't they?
Yeah, go to globalcomresearch.com, globalcom with two M's, research.com. And I know Market Talk gets out to a lot of people. And because you listen to Market Talk, if you sign up for a 1 week trial, I'll extend that to a 3 week trial. Just write in the notes section, you're a Market Talk viewer, and I'll be happy to do that because I appreciate all you do, Jesse.
Well, Mike, I appreciate the time as always, sir, and the great analysis. And have a great rest of the week. We'll talk to you next Wednesday.
Thanks, Jesse. Hopefully, we'll be in the green next Wednesday.
I hope so too. Mike Zuzolo, Global Commodity Analytics, our guest today here on Market Talk. Find us online, markettalkag.com. That's going to do it for the Wednesday, September 29th edition of the show. I'm Jesse Allen. Have a great afternoon.